A futures contract is a standardized financial agreement between two parties to buy or sell an asset, the underlying commodity, financial instrument, or index, at a predetermined price at a specified future date. These contracts are traded on organized futures exchanges and are commonly used for hedging against price fluctuations, as well as for speculative purposes. Commodity futures contracts specifically involve the trading of commodities such as agricultural products, energy resources, precious metals, and more. Here's how a futures contract facilitates commodity trading. Standardization. Futures contracts are standardized agreements with fixed terms, including the quantity and quality of the underlying commodity, the price at which the trade will occur, and the expiration date of the contract. This standardization helps ensure transparency and liquidity in the market. Hedging. One of the primary purposes of commodity futures is hedging. Producers, consumers, and other market participants use futures contracts to manage and mitigate the risk of price fluctuations in the commodities they deal with. For example, a farmer might use a futures contract to lock in a selling price for a future harvest, protecting against potential price declines. Speculation. Traders and investors who do not have a direct interest in the physical commodity may engage in commodity futures trading for speculative purposes. Speculators aim to profit from changes in commodity prices by buying low and selling high. The leverage available in futures trading allows speculators to control large positions with a relatively small amount of capital. Leverage. Futures contracts typically require a small upfront payment known as the margin. This is a fraction of the contract's total value. The use of leverage allows market participants to control larger positions than their initial investment would otherwise permit. While leverage amplifies potential gains, it also increases the risk of significant losses. Price discovery. Futures markets play a crucial role in price discovery for commodities. The continuous buying and selling of futures contracts reflect market participants' expectations and supply and demand dynamics. Prices established in futures markets are widely used as benchmarks for actual transactions in the physical commodity markets. Delivery and settlement. While some futures contracts result in physical delivery of the underlying commodity, many are settled in cash. In cash settlement, the contract is closed out before the expiration date, and the difference between the contract price and the market price at that time is settled in cash. Risk management. Companies engaged in the production, distribution, or consumption of commodities use futures contracts to manage price risks. By locking in future prices through hedging, they can protect themselves from adverse price movements and stabilize their cash flow. It's important to note that while commodity futures trading provides opportunities for risk management and speculation, it also involves inherent risks. Prices can be volatile, and traders may incur substantial losses, especially when using leverage. As such, individuals and entities engaging in futures trading should have a good understanding of the markets and carefully manage their risk exposure.